Welcome to the Daily Market Recap. Today is Friday, June 26, 2026.
What an absolute wild ride to cap off the week. The bulls and the bears threw heavy punches all day, leaving the broad market almost perfectly flat, but underneath the surface it was total chaos. The SPY dipped a microscopic 0.05% to finish at 7,354.02, while the tech-heavy QQQ shed 0.24% to close at 25,297.62.
The big headline driving the market action today was a double-edged sword. On one side, we had a glorious 3.8% plunge in crude oil prices, which brought Brent crude back down to pre-conflict levels around $72.60. That should have sparked an absolute equity rally, right? Well, the tech gods had other plans. Savage sell-offs in artificial intelligence and semiconductor stocks acted as a massive anchor, completely capping the market's upside and locking in just the second losing week for the broad market out of the last 13. When we slice up the sectors, it looks like a classic game of market rotation. Thanks to those plummeting oil bills, transportation and airline stocks caught a massive tailwind. American Airlines jumped 1.7% as fuel cost anxiety evaporated. Healthcare was the absolute darling of Wall Street today after a major European Medicines Agency committee went on an approval spree, recommending a dozen therapeutic extensions. That sent Eli Lilly soaring a beautiful 7.1%, lifting the entire healthcare sector on its back. On the flip side, the technology sector was an absolute disaster zone. Chip makers and AI infrastructure plays were aggressively sold off as investors started sweating over whether these companies can actually live up to their astronomical valuations, while energy stocks slipped in tandem with the crude oil correction. And check out the sentiment gauges because things are getting chilly. The Fear-Greed Index has officially plunged down into the deep trenches of extreme fear, tapping a reading of 25. Just a few weeks ago, everyone was drunk on FOMO, but a 5-day losing streak has completely flipped the script. Traders are pulling back, volume is getting defensive, and institutional risk-off behavior is creeping back into the driver's seat. Our top story today is an absolute milestone in financial market history. Today marked the official implementation of the semi-annual Russell Index reconstitution, and passive fund managers went into a literal feeding frenzy at the closing bell. NASDAQ officially announced that its closing cross handled a record-shattering 4.59 billion shares in exactly 1.63 seconds. That represents a mind-boggling $334 billion in notional value executed almost instantly to rebalance the Russell 1000, 2000, and 3000 indexes. This semi-annual rebalancing completely redraws the lines of market capitalization, forcing trillions of dollars of benchmarked assets to mechanically shift positions. The infrastructure held up beautifully, delivering crystal-clear, transparent pricing despite an unprecedented wall of institutional liquidity. In our second major story, the global energy market just threw a massive bone to consumers and corporations alike. Brent crude oil plummeted a stark 3.8% to land at $72.60 per barrel. This officially wipes out the entire geopolitical premium that was baked into energy since the military escalation between the U.S., Israel, and Iran that threatened to lock down the Strait of Hormuz. With oil supply routes proving more resilient than feared and production holding steady, energy prices have retraced all the way back to their pre-war baseline. This drop is a massive relief for the Federal Reserve, as lower energy costs provide a direct downward push on headline inflation metrics, giving bond yields room to ease up and taking immediate pressure off borrowing costs. Story number 3 focuses on the growing pains of the artificial intelligence boom. The AI sector faced a severe reality check today, spearheaded by Micron Technology, which tumbled 6.7%. The catalyst, Apple recently announced substantial price hikes on its new laptops, explicitly blaming the surging costs of memory chips. Wall Street immediately connected the dots, fearing that hyper-expensive hardware will ultimately trigger a sharp demand slowdown for AI tech. Adding to the sector's weird vibes, OpenAI announced it is strictly limiting its latest premium ChatGPT product line to verified Trump-approved customers while it undergoes a highly sensitive, comprehensive cybersecurity review. This regulatory and valuation double whammy has traders aggressively locking in profits across the entire chip ecosystem. All right, let's look at the individual tickers that made absolute waves today. We had some massive short squeezes and clinical breakouts on one end and absolute unconditional bloodbaths on the other. Grab your calculators because these percentage moves were not for the faint of heart. Leading the Green Brigade today, we have LCID, mRNA, DKNG, Fig Lucid Group caught an electric bid as rumors of fresh sovereign wealth backing circulated. Moderna rode the wave of the European Medicines Agency's broad drug recommendations, bringing heavy institutional buying back into biotech. DraftKings surged as retail option volume exploded ahead of a massive weekend sports lineup, proving that sports betting remains entirely bulletproof. Finally, Fortress Investment Group, trading under FIG, posted a beautiful breakout as alternative asset managers see massive inflows from institutions looking to diversify away from traditional equity volatility. Now, for the painful side of the ledger, our top losers are ON, BE, WDC, STX, ON Semiconductor took a catastrophic 23.7% beating today, marking the single largest loss in the S&P 500. The company shocked the street by announcing a massive all-stock acquisition of Synaptics valued at roughly $7 billion. Investors absolutely hated the dilutive nature of the deal and dumped shares with extreme prejudice. Bloom Energy, ticker BE, got hit with a heavy wave of profit-taking despite being highlighted in the Russell rebalance at a massive $81 billion valuation. Meanwhile, memory giants Western Digital and Seagate, ticker WDC and STX, got absolutely dragged down in sympathy with Micron's slide, proving that when one major chip domino falls, the rest of the storage sector tumbles with it. Let's break down the charts, starting with the big daddy, the SPY, with today's minor drop. The S&P 500 has notched 5 consecutive red days, marking its longest losing streak since August of last year. From a technical perspective, the SPY is sitting right on top of crucial support at the $735 level, which aligns perfectly with its previous mid-June consolidation zone. If the bears manage to push us below $732, the next major line in the sand is $725. On the upside, the bulls have a mountain of overhead supply to clear. Immediate resistance sits at $740, and we need a daily close above $748 to break this short-term downtrend and eye a return to the all-time high of $760. Turning to the tech-heavy QQQ, the chart is looking a bit precarious after logging a hefty 4.6% decline this week. The index has snapped its short-term moving averages and is now testing macro support right at the $294 level. Traders need to watch this zone like a hawk. If $294 fails to hold, a rapid descent toward the $288 support pocket is highly likely. For the bulls to reclaim control, they need to aggressively force a bounce back over the $298 resistance mark. Until QQQ can sustainably trade back above $302 billion, the tech sector remains in a sell-the-bounce posture. The small-cap arena via the IWM was the absolute silver lining of the day, showing clear relative strength thanks to the immense liquidity from the Russell reconstitution. The IWM successfully defended its vital support level at $300, closing out the session with a modest gain. The technical structure here is actually much healthier than its large-cap peers, forming a nice base. If IWM can hold above $300 early next week, look for a powerful squeeze up toward immediate resistance at $305, with macro resistance sitting up at $312. If it breaks below $298, the bullish thesis gets temporarily invalidated. Switching gears to the digital asset space, it has been an absolute battleground for Bitcoin. BTC managed to bounce slightly up to $59,688, stabilizing near the psychologically critical $60,000 threshold after briefly probing a multi-month low earlier in the week. The macro headwinds are real. Spot Bitcoin ETFs experienced a brutal $1.3 billion in net outflows this past week alone, signaling that institutional players are actively trimming risk rather than buying the dip. Technically, Bitcoin must defend macro support at $58,000 to avoid a cascading sell-off down to $55,000. Resistance remains heavy at $61,563,000. Ethereum followed a very similar defensive script, managing a mild 0.5% gain to settle around $1,574. ETH is currently suffering from a bit of an identity crisis, sandwiched between Bitcoin's institutional dominance and faster Layer 1 competitors. The chart shows Ethereum putting in a series of lower highs, with key support locked in at $1,500. If the broader tech market remains under pressure, ETH could easily retest that level. Bulls desperately need to orchestrate a high-volume breakout above $1,650 to shift the market structure back to a bullish bias. While the rest of the altcoin space looked completely washed out, Solana was an absolute rock star, defying market gravity with a stunning 8.4% surge to tap $71.85. The massive driver here is the rapid acceleration of real-world asset tokenization, as mainstream financial giants increasingly launch on-chain asset management protocols directly on Solana's ultra-fast network. However, the broader altcoin market is keeping its guard up, heavily spooked by MicroStrategy's stock collapsing 50% over the last month, leaving derivatives traders leaning heavily defensive to hedge against systemic liquidations. As we close out the books on this trading week, the overarching market sentiment has firmly shifted from blind euphoria to a highly calculating risk-off posture. Investors are no longer blindly chasing every headline containing the word AI and are instead demanding concrete fundamental justification for these valuations. The massive record-setting liquidity from the Russell rebalance shows that institutions are actively repositioning their chess pieces for the second half of the year, preferring defensive healthcare and cost-recovering transport names over high-flying tech. Looking ahead to next week, the economic calendar is absolutely stacked with market-moving catalysts. The ultimate report to watch will be the incoming core PCE price index data, the Federal Reserve's absolute favorite inflation gauge. With crude oil crashing back to earth today, the market will be hyper-focused on whether consumer inflation expectations continue to cool down from their current 4.6% level. We will also get critical manufacturing and services ISM data, which will give us a definitive look at whether high interest rates are starting to slow down macroeconomic growth too quickly. Fasten your seatbelts, keep your risk managed, and have an incredible weekend.